So picture this, CES, one of the biggest tech shows on Earth. Uber unveils the future, a real working robotaxi. You'd think their stock would have gone to the moon, right? Well, it didn't. It dropped. So what gives? What did Wall Street see that the rest of us missed? Let's break down Uber's wild robotaxi paradox.
All right, so let's set the scene. We're at the Consumer Electronics Show, CES. This is the global stage where all the futuristic, absolutely game-changing tech gets its big debut. And Uber came to play with a massive announcement.
And boom! There's the headline that got everyone talking. Uber, teaming up with the luxury car maker Lucid and autonomous tech wizards at Nuro, didn't just show up with a cool drawing or some concept car. Nope. They revealed a production intent robotaxi. Now that phrase, production intent, is key. It means this thing is the real deal, designed to actually be manufactured and hit the streets.
And this wasn't just some empty shell, The partners involved are seriously top tier. You've got a high-end electric SUV from Lucid. The brains of the operation is Nuro's Level 4 autonomous system, which means it can completely drive itself in certain areas. And it's all powered by NVIDIA's industry-leading computing platform. And get this, they are not wasting any time. Testing already started back in December, and they're aiming for a launch in the Bay Area later this year. They're moving fast.
Okay, so with news this big, a real, tangible step into a driverless, more profitable future, you'd automatically think investors would be all over it, right? The logic seems simple. Cool, futuristic tech equals a stock that's going up. But that is not what happened. Not even close.
And this is exactly where the story takes this fascinating, totally unexpected twist. The reaction from the market seemed to fly in the face of all the excitement happening on the floor at CES.
Yeah, instead of a big jump, Uber's stock actually closed the day down almost 2.6%, and that drop put the shares a full 21% below their 52-week high. So think about that. On a day that should have been a huge victory lap for the company, investors were actually heading for the exits.
So what is going on here? This is the core of the paradox. Why the huge disconnect? To really understand what happened, we've got to look past those splashy CES headlines and see what Wall Street was really paying attention to. All right, let's dive into the big concerns that were driving this whole negative reaction. Because as it turns out, Uber's big robotaxi announcement basically collided head-on with a brand new and pretty pessimistic analysis from a major research firm.
And here it is, the heart of the bear case. On the very same day as the big reveal, Melius Research slapped a sell rating on Uber stock. And their reasoning? Well, they argued that as this whole robotaxi world gets more crowded, Uber might not be the one holding all the power. The big fear is that all this new competition could actually hurt Uber, not help it.
Now, to get why that's a risk, we've got to talk about something called the take rate. It's super important. Basically, it's Uber's slice of the pie for every single ride. If your ride costs $20, Uber might keep, say, $5, and the driver gets $15. That's the lifeblood of their business. But what happens when the driver isn't a person anymore, but a robot owned by a completely different company? And this right here shows the huge strategic choice Uber made years ago. It was like a fork in the road. They decided not to build the self-driving tech themselves, which is incredibly expensive. Instead, they chose to be the platform, the app that connects you and me to other companies' robotaxis. Now, this saved them billions in R&D for sure, but it creates this brand new risk. If companies like Nuro or Waymo or even Tesla own the really valuable technology, then they have all the leverage. They could demand a much bigger piece of that $20 fare, shrinking Uber's take rate and, well, their future profits.
But, okay, that one downgrade, that's just one piece of a much, much bigger picture. Because if we zoom out from that one weird day of trading, the long-term story for Uber starts to look incredibly different.
So let's take a look at who actually owns Uber. A whopping 80% of the company is held by institutional investors. We're talking the big hedge funds, the massive investment firms. This is what you call the big money, and despite all the daily noise and stock swings, they are overwhelmingly long-term believers in where this company is headed.
And honestly, they've got some very good reasons to be confident. Just look at Uber's last earnings report. The company posted earnings per share of $3.11. The estimate from Wall Street? Just 67 cents. This wasn't just a small beat. This was a massive signal of real profitability and serious operational strength. They absolutely crushed it.
And remember that sell rating from Melius? Well, it turns out it's a total outlier. You've got 31 other analysts who rate the stock a buy or a strong buy, with only 8 sitting on the fence at hold. The overwhelming consensus here is that Uber's future is looking pretty bright, which is why the overall rating is a moderate buy.
So here you have it, the two competing stories laid out side by side. You've got the bear case. They're worried about that Melius sell rating, intensifying competition in the self-driving space, some recent selling by insiders, and of course those big questions over the take rate. But then you have the bull case, that huge 80% institutional ownership, that massive earnings beat, the strong moderate buy rating from most analysts, and revenue that's still growing over 20% year over year. It's a real tug of war.
So, with these two completely opposing views floating around, what are investors looking for next? What's going to be the thing that ultimately proves which side is right?
Well, there are 3 huge milestones coming up that everyone is watching. First, how is the current on-road testing actually going? Are there any hiccups? Second, can they really hit that ambitious target for commercial launch in late 2026? That's a big one. And maybe most immediately, what will their next earnings report coming up on February 4th tell us about their current business momentum? Each one of these is going to be a critical piece of the puzzle for investors.
You know, when you boil it all down, this whole debate really comes down to one provocative question that a critical analyst brought up. Is Uber the exciting future of transportation, or is it on its way to becoming the new Comcast?
And that's really the core of it, isn't it? Is Uber a high-growth tech innovator that deserves a sky-high valuation? Or is it becoming something more like a massive, essential, but ultimately lower-margin logistics utility? The market is literally trying to decide right now, and the Robotaxi strategy is right at the heart of this identity crisis.
So what you should really take away from this is this incredibly complex tug of war between a really bold long-term vision and some very real short-term fears in the market. The path Uber's chosen is absolutely full of promise, but it's also packed with risk. And the real question, not just for investors, but for the future of our cities, is which one of those is going to win out? Is Uber actually building the future, or are they just paving a very smooth road for someone else to drive on?